You're not like first or fourth floor of the mimosa.
Yeah. So I've heard
That's rough.
that is how.
I was second floor there
I've
freshman
only
year.
been to
Yeah.
New York and
That was hot.
Yeah, I'm third floor,
I
so
went
that's
to the
why
London one,
I
which
get it
was apparently
slightly.
the first one,
That's hot.
really?
and that was awesome.
Awful.
The one in Rome was also
That's why you
good
gotta
though. They had
the big
the
boy and girl
ceiling
going.
was
Yeah.
painted
So excited for the
angels, like the
We
the
can
baby.
like adjust
Is this where you
the.
live in actually?
They had musical instruments. It was really awesome.
We can adjust like the temperature in here and
You guys should just go sleep in this room. It's cold in here.
everything. Yeah. Yeah, that's true. I can. We actually probably could drag our mattresses across the street. It's fine.
I don't know, pull in the couch from.
Oh, I'm smarter. And they have those comfy chairs in the conference rooms. Classrooms and other people.
how did you find information on certain things rent or buy? There's different values. So,
Okay.
insurance, where did you find information?
Insurance, I basically,
Yeah, that's a smart
Well
idea.
done.
That's a good idea.
the one it told me, the other one I did like
Here, I'm trying to give blood like last time a lot of people were here.
a family.
And they were saying like you need to
Average
have
price
made
of
an
it.
appointment.
No, you don't.
That's what I'm kind of doing.
Where's it at?
I just
The
want to do
rec
that like
center.
one
They're
precise
taking a
thing.
walk-in every 15 minutes. So you do, like, if you want to definitely get blood, you can appointment, but, like, I saw people come in.
Alrighty, so let's start by discussing the previous puzzle. As you might recall, this lead word statements, and we're trying to avoid the dagger. So who would like to venture a solution to this? Alright.
You pick the lead because if you're going based on the last statement on whether it's true or false, if it's true and the other two are false then because of that, then it would be in the silver. And if it's false, then either all three could be false or that one could be false and the other two could be true. So if all three were false, then it's still in the silver, and if that one was false and the other two were true, it's in the gold. So then the only one that it hasn't been in is in the lead.
Alright, I'll buy that. Now, just one thing: if the third statement is false, then the other two must be true. Because if it is false, that at most one of these was fashioned by Bellini, then two or more must have been fashioned by Bellini, right? So either this one is false, the other ones have to be true, right? But the rest of it is still correct, right? Essentially, either the dagger is in the gold or in the silver, but under no circumstances is it going to be in the lead. Okay? Alrighty, so now let's look at a variation on this problem. You ready to move along? Okay, so last time we discussed the basic ideas of insurance, right? And the core pervading structure of the idea of insurance is that the insurance provider is going to look at the expected value of the loss, right? Which is the probability times the loss, right? Summed over all the possible losses that are being covered. And they're going to tack on a bit of a premium, which may be larger or smaller depending on the provider, right? And then charge you that price. And because they're aggregating the risk over many, many people, for them, on average, everything is going to be fine. If they're insuring the people, like 1,000 of them incur some kind of a loss, they're still going to be making money because the expected losses for them are going to be less than the premium that they're charging, right? Because of the extra profit that they tack on top. And so as a result, it is beneficial to us to essentially try to assume as much of the risk as we reasonably can, right? Because to try to transferring the risk costs that extra bit of profit to the insurer. You're paying from the expectation, you're paying money to the insurance company. So if you can avoid transferring some part of the risk and still be financially safe, then it is a positive expected value proposition for you to do so, right? So this idea of only insuring the risk that you cannot reasonably bear is really going to be a pervasive idea in all types of insurance that we're going to talk about. You don't want to insure the random small crap that you can basically swallow yourself, because in the long run, you're going to be paying more money if you insure it than if you don't, right? Let's first talk a little bit about life insurance, right? So there are many types of different insurances, right? We have life insurance, we have health insurance, various kinds of property insurance, right? So there are many different types of risks out there, and quite a few of them can result in significant losses. So it might make sense to insure those significantly large catastrophic losses that can occur. First of all, let's talk a little bit about life insurance. Now, being relatively young and probably most of you do not have dependents, you actually do not need life insurance, right? Because certainly not for you, because once you die, right? You can't take your money with you, right? So the reason people take out life insurance is to provide for their dependents in case they're no longer there to provide for them, right? So if you are, a single person, you don't have any dependents, and if your parents are still alive and healthy and working, and you're not taking care of your parents, you don't need life insurance, right? Because for whose benefit are you getting life insurance, right? When you die, like nobody, you don't need to take care of anybody. That's generally something to keep in mind. You don't, sometimes. Sometimes life insurance, as we'll see, could be sort of misused or misthought about, as we'll talk about in different types. But really, the basic point of the life insurance, right? It is to essentially protect your dependents against your untimely death. Probably for most of you, this is not going to be a very in the short term, it's not going to be a very important topic to think about. But still, it's a good idea to know what it's all about, so that in the future, if you ever encounter it, you have a basic thinking structure of what all these different things are. Right? So, originally, the only type of life insurance that existed was term life insurance. Essentially, every year, you would go to the insurance company and say, what premium are you going to charge me for this year to give me such and such amount of death protection, right? So let's say like if I die, I want like $250,000. How much are you going to charge me for this over the course of the next year? Right? If you're young and healthy and do not make it a habit to wrestle crocodiles, it's probably going to be relatively cheap for this 1 year for you to buy this life insurance policy, right? And then, you know, if you're still alive at the end of the year, you go to the insurance company again and say, how much are you going to charge me this year, right? And they'll again estimate your risk and give you the premium for this next year. So this is this is essentially like the core function of life insurance, right? You're paying for you're paying the expected value of the payment times the probability of your death plus a little bit of a premium. All right? Now the problem is that as you're young and healthy, you can get away with pretty small premiums. Right? So if it so happens that you don't have dependents but you want some life insurance, a lot of people do go for term life insurance because it's relatively cheap. Like every year you estimate the risk. And when you're young, the risk is small. Right? However, the problem is, let's imagine that you've been using term life insurance for a long time. The older you get, the greater the probability that you're going to die in any given year, right? And because the premium is reset to whatever your risk of death may be at the time, right? The premium is going to grow higher and higher the older you get. So maybe if you are, a 25-year-old person with no huge health conditions, you can get a term life policy for maybe, $100 to $150 a year. That is going to pay you like $150,000 or whatever, right? It's relatively cheap, right? $150 for a whole year, right? And if you die, they pay you a lot of money, right? But of course, the insurance company knows that you're not very likely to die. But, let's say if you're 60 years old and you try to get the same term life policy for this next upcoming year, they're not going to charge you like $150 a year. They'll charge you $1,000, right? I mean, $2,000, right? They have actuarial tables of data of like how likely people are to die and what are the different factors associated with the different probabilities. So I mean, obviously, like they'll give you like a health exam, and like you have bad heart, and high cholesterol, or whatever it is, you know that the probability of death is a little bit higher, right? For all the different factors. And so as a result, like if you just hang out and stick to term life insurance, eventually you're going to be paying thousands of dollars a year for the same term life coverage, right? And so people are saying, a lot of people are saying, that it doesn't sound so awesome, right? Because I can pay not a lot of money when I'm doing okay and healthy and young, but like once my risk starts increasing, they're really starting to that premium. Right? I'm not happy about that. And historically, only like 3% of all term life policies have ever paid out, right? Because essentially, you get it for 1 year, nothing happens, it doesn't pay out. Like the insurance company pockets the money, and they're very happy, and everything's cool, right? With that in mind, they invented this idea of whole life insurance. So they said, okay, if you're not very happy with sort of recalculating your premium all the time. Oh, and by the way, one more thing, eventually, if you're really old and you have really serious terminal conditions, they might just refuse to issue you a term life policy, right? So, like at some point, once you get old enough, they'll be like, okay, you're no longer insurable, right? So at that point, that kind of sucks, right? Yes.
So you could be like paying for life insurance your whole life, but then you get to the year you're actually going to die, and
If you use term life insurance, which is basically recontracted every year anew, then yes, it's not basically you can get to like 70 years old, and so you have whatever medical conditions you might have. They're like, no, we're not going to insure you anymore. And because term life is basically a fresh contract every year.
okay, like all that money you've been paying for 40 or 50 years that you've gone.
Right. If you're still alive. Right? Well, I mean, but it's, it's the same thing, right? If you're, if you're paying home insurance and your house never burns down, all that money's gone, right? But the fact is that if something were to happen, you were protected, right? So insurance is not supposed to be a positive expected value proposition, right? It protects you against something bad happening, which is usually relatively unlikely. So if it happens, right, you have some protection because you don't have enough financial resources to swallow a large loss. Right? But most of the time, large bad things are not going to happen, right? So sometimes it's going to happen. You want that protection against a small chance. Most of the time, it's not going to happen. So most of the time, it's going to be wasted money. But it's easy to say, looking back, oh, nothing happened. I just wasted all this money. But looking forward, you're probably happy that you have this protection in case something happens.
So,
Right.
but like that money that you had been spending, say you were to die when you were that year that they decide not to cover you, all
Right.
that money is just not going to go to your dependents, or what?
No, it was a fee that you paid for past years, and the insurance policy terminated. Now it's the next year. You no longer have insurance, right? If they refuse to cover you, or you decided not to renew because it's too expensive or whatever, and then if you die, like that's it. Just like if you decide not to renew your home insurance policy and your house burns down, well, guess what? You're screwed, right? But I mean, exactly. So people were saying, that it's not so awesome, right? And so as a result, they invented this concept of whole life insurance, which essentially, you set up a contract right up front for whatever the fixed fee you're going to pay for the duration of your life, and is going to provide you with some amount of coverage in case you die, right? And so now, right? So let's if we look at the graph, let's imagine right? And let's imagine that this is probability of death, right? So let's say that if you're looking from starting from a 20-year-old out to like a 100-year-old, right? What do you think this probability distribution is going to look like? Yeah, it's going to look kind of like that, right? So this is so this is the probability distribution of death. All right. Once you're pushing 2 digits, like you give that. That's the way it is. And hopefully by the time we get to 100 years old, life expectancy will be higher. But like at this point, people who are 100 years old will probably right? So this is the probability of death. So let's imagine, given that you are taking out like $250,000 or $500,000 life insurance policy, the expected value of that policy is the probability times the payout, right? So the insurance company is going to say, right? So here you are, here's 20, here's 21. You take out the term life policy for the next year. So what is the expected value of this policy? Or the small probability times whatever coverage you're taking, right? Alright, so you're going to say, okay, so maybe the probability of dying when you're 20 is, let's say 1%, maybe next one, right? And let's say the coverage that you're taking is, say, $200,000, alright? $200,000, so what is the expected loss that you will experience? $200,000 times 0.01, that is $2,000. Actually, do the pot. So I give the probability of dying is not 1. Right? So let's call it, 0.05. Right? And then people. So, all right. So if you're taking out a $200,000 coverage policy, the minimum expected value is 23. $200,000 right? And what's going to be the expected loss in that? Like $100, right? Right? $100? Okay. So it's about $100, right? And so then the insurance company is going to say, okay, so our expected loss here is $100, we're gonna tack on a nice juicy profit margin, and that's how much you're gonna pay for this 1 year of term life insurance, right? So that's, so we're gonna add, 20%, and we'll charge you $120 a year for this 1 year of term life, right? And then next year it rolls around, and we're 21, and they're gonna say, oh, look at that, 21, and the probability of death is essentially still really low, right? So, whatever the statistics say, the probability of death, it's actually possible that the probability of death starts out a little higher, and then goes down, because young people tend to do lots of things, right? So, I don't know what the actual probability is looking like, roughly speaking, it's looking kind of like that, right? And so until, the next year, we'll charge you like $125, by a similar logic. But, if you're coming into them and like you're 80 years old and you say, I want term life insurance, right, for $200,000 coverage, well, they're going to say, here you are 80, your probability of dying is like this much, right? And so, I don't know, maybe, what percentage of 80-year-old die every year? Could be something like 10% of them, right? I don't know, right? Because right now, the life expectancy in the United States is just about 80 years old, like high 70s, right? That's an average that includes all the people who are like really obese and like do really stupid stuff, right? Maybe if you take care of yourself, take care of your health, you are in the group with high levels. But as an average, right? So, that's about it. So you're going to say, okay, let's imagine, we're going to look it up. Let's imagine that this probability is 10%, right? So there's a 10% attrition among 80 years old. And so you're going to say, well, how much are we going to charge this guy for this 1 year of term life policy, this $200,000 coverage? Well, it's going to be quite a lot, right? We got $200,000 times 0.1, which is $20,000. Let's tack on the fee, right? And pay $21,000. So yeah, it will be $21,000, right? So, at this point, you might say, maybe it's not even worth it to me to pay $21,000 for it. I'll just keep my $21,000 and give it to my dependents, right? Somebody had a question? Right, so this is the idea, like why the cost of term life insurance goes up with your age, and at some point they get it, right? So when you have whole life insurance, they would set a fixed premium for yes.
With the 0.05%, how do you get from 0.05? I'm giving you a name.
Right, so 1%, so 1% is 0.01, right? 0.1% is 0.00. Right, and 0.05%, you add another 0.05. Right? So it's essentially the 0.05 divided by 100. Right? So that's what the percentage is. Make sense? I'm glad you're paying attention to this miscounting zeros. It's very common. In this case, we do all right. Okay? So we invented the whole life insurance policy. So what we're going to do is we're going to set a fixed premium for the entire life. And as long as you continue paying the premium, you're going to be covered with your life insurance policy, and the premium is not going to go up. Right? Now, if we do that, guess what is going to be the size of the premium if we go and buy the whole life insurance policy right now? Is it going to be $120? Of course not. It's not going to be like, it would be $120 if the probability of death remained low throughout your life, right? But of course it didn't. So if the insurance company on average still wants to make money, they're going to set the premium somewhere about here, right? So that you're going to, when you start getting your insurance policy right now at the start, this is going to be like some kind of, the premium is going to be some kind of a weighted average of the future expected losses during your life, right? It's going to be higher than the lowest possible loss that you have right now, So maybe a whole life insurance policy will cost you like $500 a year instead of just $100, right? So of course that means that as you're paying $500 now for the first, we don't know where this cost the point is, right? But if you can see that in the younger years, you're going to be paying more than the expected value of your loss coverage, right? And then once you cross some kind of a threshold, we don't know where it is, maybe it's right? The expected probability of death is higher than the premium, but because you paid all this extra money for all the previous years, the insurance company is like, okay, it's fine, right? So of course they're going to set it in such a way that they still make whatever their profit margin is, right? So essentially they're looking at the sort of like an integral of the expected value of loss over the entire expected lifetime of the person to see what is the total loss. They set a premium so that it covers that plus a dividend. So then you're saying, well, if I want to get term life insurance policy right now, I only have to pay like $120. If I want to, but that will only cover me for 1 year, and then I have to get a new one, and then I have to get a new one, and that will grow. But if I get a whole life insurance policy, well then I'm going to be paying more money up front, it's like $500 a year. But as long as I keep paying that, my life insurance will be enforced. And even when I become 80 years old, the insurance company can't say, you know what, not going to insure you anymore, right? Because you have this policy for life. Now, if you stop paying the premiums on the policy, there are different conditions and different policies. Like some of them have basically a non-renewability clause. So if you stop paying, but then you resume paying later, it's still active minus some amount of coverage that you missed by not paying, right? So this seems kind of a better way to spread out the risk in a way, if your goal is to basically have a long-term life insurance coverage, right? So this brings in some interesting dynamics to the whole life insurance policy. Because in the early years, when you were paying your premium, only $100 of it actually goes to insuring your risk for that particular year. And the rest of it, the other $400, let's say, we're assuming that the other $400, it just goes into sort of a holding account, waiting until it becomes needed, right? So what actually happens is that the whole life insurance policy actually builds cash value over time. So it's sort of like a mix of an insurance product and an investment product. So, yeah.
I was just going to ask that, like banks do insurance companies, I know that like they'll take the money that other people didn't use and use that for other people, but do they make investments with the money as well?
I mean, of course, right? So the insurance company is going to hold this money basically for you in your policy, right? And they're actually going to let this money that they're holding accrue a certain amount of interest, right? So it's plain whole life insurance policy is going to say, we're going to accrue like 2% or like 4% like fixed interest for the life of your policy. So it's not like you put in 400 and next year it's still worth 400, right? They're going to say like this is going to achieve some kind of a positive investment return, right? That's why it's sort of like an investment product, right? Because you do get a return on this extra money that it doesn't go to actually covering your risk while it's sitting there, right? Now, of course, the insurance company is not giving you this 2% out of the goodness of their heart, right? They are probably actually investing it at something higher, taking a little off the top and giving you a little bit. So it's kind of just like a bank, right? So a plain whole life insurance policy which promises like a fixed interest, they would probably be investing in more safe instruments because they know they have to they're guaranteeing the minimum rate that they're going to give to you. All right. So we'll get on to talking about a variable life insurance policy, which actually doesn't guarantee you a fixed rate. But we'll get to that in a little bit. But essentially, so you can see what's going to happen. Alright. So there's H. There's your 8, and this is going to be the cash value of your life insurance. Right? So what's going to happen is that, let's say you started this life insurance policy when you're 20 years old. Right? Now, possibly maybe you should, because you don't need that right when you're 20 years old. But you know, just for example. Alright, so here at age 20, what's, after the first year, what's going to be the value of the cash value of your insurance? Well, we said that, your term life policy, if you just insured this 1 year, the expected loss would have been like $100, right? And like a little tack on premium for like 1 point, right? So if you pay $500, then $380 of it goes to build your cash value, right? So after the first year, you get $380 in your cash value of your policy, right? Then after the second year, let's say this is now we're 21, right? If your term life premium would have been, say, $125, and then $375 of your $500 premium adds to your cash value of the policy, right? So 380 is going to grow by 2 or 4, 3%, whatever it is, right? Whatever the stated investment return on the whole life policy is, right? Plus you add another 375, right? So if it's 2%, what's that going to be? An extra $8 or so, plus 375, right? And so you're going to add, what is that? 700 and right? So something like that. 763. There's your value of life of your policy, right? And so on and so forth, right? So every year you're going to be adding whatever it is that's missing, or sort of overage relative to your term life, to the top of the cash value of your insurance policy. All right. So hypothetically, what's going to happen is that by the time you're getting here, the cash value is going to be putting stuff in, it's going to be growing, right? And there is your top, 200,000 life insurance, right? So, at some point, the cash value of your policy this policy is actuarially structured so that eventually the cash value of your policy will reach the level of your life insurance coverage. Right? So in effect, eventually you're insuring yourself by having this savings plan. Right? But if you happen to die right over here, right, the company will pay you the whole $200,000. If you happen to die right over here, it will pay you the whole $200,000. Right? But if you're dying over here, the company is no longer actually spending any of its own money. Because now you have enough cash value in the policy and it's going to give whatever cash value you put up. Right? Which may be more than your, maybe even more than your $200,000 theoretical coverage. Like if you build up more cash value. Yeah.
So they wouldn't keep that extra as profit?
No, they already took a bunch of profit
Yeah.
by paying you 2% while they were earning 4%. And they already took more profit by, taking, the premium here, right? So they're taking profit all along. Don't you worry. The insurance company is doing just fine. Okay? So this is the basic idea of a whole life insurance policy. So it's sort of like a mix of insurance, which is the term life component, right? Which actually is the expected value of your loss. Plus, the investment component is the extra that you need. Right? So if you start your whole life insurance policy like when you're 20, then you look at this distribution and look at the average and go, okay, so this is about where we're going to start. But like if you wait until you're say 30, then you do it here. So now they're looking just at this piece of the distribution. And you say, well, the average is now something like this, right? I mean, alright, so that's why, the earlier you start a whole life policy, the lower your fixed premium is going to be, because you're going to pay more years worth of premium. And those extra years will be coming at the front where your risk is the lowest, right? Make sense? Are you buying that? I'm not necessarily,
So would you say that the life insurance is a good idea to get with or?
yeah, if you don't need life insurance right now, like if you don't have dependents that rely on you for your income, then you probably just shouldn't bother with life insurance in the first place, right? Because basically, if you're saying, well, I want to, and so you can see that there at the end, like buy term and invest the rest. That's the idea. Like, you don't really need a whole life insurance policy. You can just buy term life insurance and invest whatever extra you would have paid for whole life on your own account, right? And generally, because the life insurance company pays a relatively small rate of interest because they want their profit, right? You would, on average, you would do better if you invested on your own, right? Instead of getting 2%, maybe you invest it in market returns and aim for an average of like 9 to 10%, right? Now there are certain other considerations though, because the investment growth in your whole life insurance cash value policy is actually tax deferred and actually tax free if you die, right? Now if you actually withdraw your cash value before you're a certain age, it will be like you have to pay the back tax or whatever, right? But in general, this is tax free growth, so this is a tax advantage mechanism for investment. So if you get 2% tax free, this is just as good as getting 3% not tax free, right? Assuming you're in about the 33% marginal tax level, right? If you take 3%, subtract 33% of that, you're back to the 2%. But still, insurance company is not going to give you a rate of return on which they're going to lose money. They know that they're going to take a little bit off the top. So, if you have the discipline to actually invest the extra money, right? Then on average you're going to be better if you stick around with pure debt protection and invest the rest on your own, right? So that's one thing to consider. So because a lot of people were like, not a lot, but like relatively a lot of people started doing that, insurance companies came out with the variable life insurance policy. So it is exactly it's sort of like whole life, but instead of promising you a fixed rate of return on your cash value, they say you can choose where to invest your cash value. And they offer you a menu of mutual funds of various types that you can invest, right? So as a result, you could say, if I do that, I'll take a little bit more of a risk, right? Because if I invest in mutual funds, maybe the market goes down, but my cash value of the insurance policy will actually go down, right? Because your return varies with the market. But on average, over the long term, and because we're talking about life insurance being over a decade, over the long term, it should do better than just getting the fixed 2% or whatever the insurance company might be promising, right? So that's kind of like a hybrid, hybrid between the two, between whole life and term life, and buy term, invest the rest, right? But again, of course, remember, if you do that with the insurance company, there's going to be more fees involved, right? I mean, the mutual funds that they're going to offer you, like there's going to be some of them might be run by the insurance company. They'll have higher fees, right? They'll charge a bunch of administrative fees for managing your account, etc. So again, you still do better if you invest on your own, but it's relatively close, and you do get the tax advantage status from the growth of your cash value of the policy. So it's different. Now, one thing is let's imagine that you say I have children, and I'll have to support them for the next 20 years or however long children take to grow up these days. right? And so I really need life insurance coverage for these 20 years before like they're all grown up and like out on their own. But like after they're out and they're working whatever, they're no longer going to be depending on me, right? Because they're independent. So maybe I don't need that much life insurance coverage, right? So I mean, while I'm supporting like a handful of kids, maybe I want to take out a $500,000 life insurance policy. So if I die, I have money to my kids will have some money to support, right? But once they're out, I mean, I don't need to have a whole lot of money to if I die, my kids are going to be fine anyway, right? So in that case, maybe it makes sense to just buy a term life policy for say the next whatever, however long your kids still have to grow up, right? Maybe 20 years to buy the term life policy. And after that, you say that for $500,000, and after that you say, no longer need the $500,000 for life insurance. And maybe my employer already provides, actually a lot of employers provide group life insurance. But basically it's sort of like group health insurance that we'll talk about later. So basically like they give everybody like life insurance, usually about like over a year's worth of salary. So they say, have that, that's enough for me, and I'm not going to spend any more money on life insurance. Right? Because remember, like the point of life insurance is not to make money, right? Because you're going to die if you make money and you die, you're not going to be able to use any of that, right? It's to protect your dependents. So you're trying to see what is going to be the most efficient way to do that. So it's not necessarily the case that you should go and buy whole life insurance right now while it's really cheap, because it's only cheap because they're averaging out over a longer span of time, right? They've been paying all these extra years with this extra premium. So, I mean, it's not necessarily a bad idea, right? If you say like have some extra money and then think it's great to have a tax advantage way to invest it, it's not a bad idea, right? But really, you should compare what is the next best alternative for all that, right? As always, you should compare it.
I know my cousin was a financial advisor, and she wanted me to spoil like insurance and stuff, so I got a policy with himself, and I paid like $20 a month, and that's like whole fix for the rest of it. That's all.
Okay. What's the coverage?
I mean, it was.
So maybe it's like for $1,000.
No, I don't, like, she wouldn't have made me do it if she was. I was just wondering what you
Right. Yeah, I mean, like again, you should see what is the promised investment return on the policy, what is the coverage limit before like you can say, oh, it's really good deal or not so good, right? So yeah, I mean, there's your personal little homework assignment. Go and read what your policy actually says. Right, but you see, like $20 a month is like $240 a year. Like because you're so young, you're like all the way on the rest of the distribution. Right? So the average is relatively low. So it's fine if you can as long as one thing to check is that the policy doesn't like terminate when you do make a payment.
Yeah.
Right? So it has to have this renewability provision. So like you have some year you say, I don't want to make my insurance payments because I have something else I need to do, right? The policy doesn't just say, oh, okay, that's it, dead, right? You don't lose your cash value, right? You still have your cash value, whatever you build up, but like you don't have the insurance. Right? Any other questions? Okay, so that's sort of the basic idea. Just one thing, another interesting thing is there are insurance policies where you can basically pay a large one-time lump sum in exchange for a certain amount of whole life insurance coverage. Now the reason you might do that, because obviously, like if you say I'm going to pay one lump sum for $200,000 worth of coverage, maybe they'll charge you like $150,000. And so you'd be like, why would you want to do that? Well, the thing is, when life insurance pays out to your heirs, that is free of estate taxes. So it is kind of a mechanism to transfer some of your wealth to your descendants and like bypass various estate taxes. Now, I mean, estate taxes is a whole other issue that we probably will get around to talking about later on in the course if we get to it, right? But essentially, it's like it's a nice backdoor way to passing off some money tax free, right? So there is it's possible to like spend a bunch of your money and get a life insurance policy, and like maybe you die soon, maybe you don't die soon, like you don't know, but essentially you just manage to bypass all sorts of estate taxes. And also life insurance proceeds go directly to your heirs, not passing through your creditors. So when you die, you have a bunch of you have some liabilities possibly, right? So maybe you have an unpaid mortgage, maybe you have some credit cards, whatever liability you may have, right? So before your money is distributed to your heirs, the creditors are going to have a claim on some of your assets, right? Because they say, well, this guy owes me money. Well, life insurance proceeds are not touchable by the creditors. So again, if it so happens that you have a bunch of debts when you die, and it's helpful to your heirs to get a life insurance policy rather than just cash, because your creditors are going to have a claim on some of that. But that's kind of a sort of nitty-gritty details that. So all of these things can get as complex as you want them to get. There is a lot of detail on all of this, but this is the basic idea. And so, any other questions? Is this life insurance, the whole idea of life insurance making sense, more or less? Okay. And by the way, how nice is that again we get to rely on probability distributions. Statistics. Awesome. You're not a fan? It's awesome. Believe me. I mean, don't you see how useful it is? All right. So, let me see. All right. So another type of insurance that we'll talk about is health insurance. Now again, health insurance, our bodies are essentially like complicated machinery and kind of stuck when it breaks down. And some of those repairs can cost quite a bit of money, right? The reason we would want to have health insurance is because if I do break a leg and go to the hospital, I don't end up paying $5,000 for whatever hospitalization and surgery charges may incur, right? Because health expenses can be fairly significant. Now there are certain regular minor ongoing health expenses, like going for a health check, or going to the dentist or something like that. And again, depending on our needs, in general, it's a good idea to be able to swallow those expenses yourself, right? Because if you insure them with an insurance company, you're going to pay the expected value plus a little bit, right? Just as we discussed before. To that effect, health insurance policies generally have a deductible that you can set. You can get a deductible of $500 a year, $1,000 a year, $2,000 a year. So basically, it says that as long as your health expenses don't exceed that deductible in the year, you pay out of your own pocket. But once you exceed those expenses, then the insurance is going to kick in, right? So that means that up to $2,000 a year, you swallow on your own, and if something bad happens, you need even more, the insurance company is going to cover it which on average is going to be in the long run cheaper for you because you don't pay the extra insurance company profit on the expected value of that. Right? So if you're working for some company, like as an employee, most of the time the employer will offer some kind of a group health insurance policy, right? Essentially, the employer negotiates with a health insurance company, like as a group on behalf of all of its employees, right? And they get some kind of a policy that everybody can take advantage of if they so choose. And oftentimes it is kind of like a perk of the job, like the employer partially covers the cost of the group health insurance policy, right? Like for example, like here at Rowan, the employer covers like 2/3 of the health insurance premium. So of course, if I have the choice between like going and getting my own health insurance policy versus sticking around with this one and the employer is going to pay 2/3, guess what? I'm going to stick around here, right? Because 2/3 of health insurance premium is not something that you just find sitting on the side of the road. But again, if you do not have, if your employer doesn't offer an attractive health insurance plan or doesn't pay anything by itself, just offer you the option to buy, then it really pays to shop around and see what you can get elsewhere. Like these days, it's really easy to go around and get a bunch of quotes from different insurance companies and like see what are the different features, what are the different coverage limits, deductibles, this and that and the other, and see what you're going to be paying for all of this stuff, right? And a lot of times, if the employer doesn't cover, some significant fraction of the group health insurance, it actually is cheaper to get your own policy, right? For example, like right now, the stated cost of health insurance at Rowan is something on the order of like $500 per month. Right now, I get to pay like 150 of that, and Rowan gets to cover the rest. Like, okay, pretty sweet. But if I go out to the internet and look for for independent health insurance that I can buy by myself, I can get away paying like $300. So if the employer didn't cover anything, said here, buy our health insurance for $500 if you want, I would say no. I'd rather buy this one here for $300, which has the same coverage, right? So it always pays to go around and look, what else you can get, right? Unless you're getting a particularly sweet deal, right? Now, of course, if I had the choice of saying, instead of paying the extra, the extra $300 that you are contributing to my health insurance, just give me the cash, and I'll take care of my health insurance. I would probably do that because I get an extra $300 from them, plus the $150 that I pay, and instead I pay $300 to the health insurance, and I get an extra $150 a month. Now, of course, the problem is that they're not going to do that, right? It's like a benefit that you can get if you want, like that they will pay some fraction of the health insurance, but if you don't want it, you don't get any extra money. You're like, okay, you don't want it, you don't want it, right? So in that case, basically, it's kind of like, there is no choice. I can either get this for 150 or get that for like 300 or 250 or whatever. I don't get to take the extra money from them. So basically, it makes sense for me to just stick around with the employer policy because I cannot get a better deal than 150 anywhere else at this point, right? One particularly useful site if you're going around and trying to compare different insurance, health insurance quotes, is called ehealthinsurance.com. Right, and if you go there, you can just enter your age, your location, your gender, and that's pretty much it, right? And you submit it, and they give you dozens of different quotes from different insurance companies on all sorts of different plans, right? So you get some HMOs, you get some PPOs, you get some high deductible plans. You get some catastrophic medical plan, whatever. You have the pick of them, and you can take a look at what kind of rates you can get. Yeah.
What do you said around covers like 2/3? What's like the average for companies cover? that
It
there's
really-
a lot.
It really differs. You know, like a few years ago, it used to be common that the company would just cover completely the entire health insurance,
Yeah.
right? And so, like, if you were hanging out and like the employer offered a health insurance plan, you're like, free health insurance, I'll take it, right? But over the past probably 5 years or so, it has become a lot more common for the employer to cover only a fraction or like none at all. Right? So because like because of the whole financial crisis and like the recession and whatever, they're trying to cut costs and all that, right? So it's hard to say like what the average is. Like you could probably go on the internet and look it up, but I can change it. Like it's in flux right now because this is relatively new that it has become common for for them to cover none or only part of it. But it used to be like they would just give health insurance fully paid for as part of the work of the job. Yeah.
Even the state's doing that, like a lot of the state employees I work with, all pissed off that now they have to start paying for part of their health insurance.
And that's right. Rowan is a state school, right? It's a state institution. So, I bet, and I wasn't here this long, it was only my second year, but I bet, 10 years ago, you just get health insurance and not have to pay anything, right? But now, I got to pay $150, right? So, it's things are moving, but still, you always got whatever the situation is, you got to look around and see what is the best deal, right? There are different types of health insurance plans, right? So the HMO basically stands for like Health Management Organization or something like Health Maintenance Organization, something like that. All right. And basically, they restrict you to their network of doctors and providers. So if you go to one of the doctors who is in this HMO network, they'll generally have pretty good coverage of whatever expenses you may incur. But if you go to somebody who is not in the network, they'll either like cover nothing or cover a really small percentage, right? But on the other hand, in general, they tend to be a little cheaper because they negotiate a rate with all of their providers, right? And as a result, like everything else being equal, getting an HMO with the same coverage as say a PPO or a POS is going to be a little bit cheaper, right? Now the PPO and POS plans basically, PPO is basically you go anywhere you want, and then you submit to them your medical expenses, and then they say, okay, we'll reimburse you this and that. Right? And again, usually they have different, health insurance has a lot of different limits for different things. They would say we'll cover this much of hospital stay at most, and we'll cover this much of that at most, right? You have to look around at all the details of the health plan to see what's going on. The P plans, they kind of give you more flexibility because you can go out of network if you want to. Like if you say, have some problem, you found like a really good specialist that specializes in whatever, and you don't have to really think, is this guy in the network, right? You can just go to him and it's going to be the same as if you go to any other guy, and the expenses are going to be covered, subject to whatever you find in. So, whereas with an HMO, you're stuck in the circle of the doctors and hospitals and providers that are in the HMO network. So, again, it depends on the size of the network, and it depends on what is the concentration of their providers in your area. There is nothing wrong with being in an HMO if they have a lot of different doctors in your area, so you don't have to worry about it, right? But for some HMOs have different, if they have really a relatively sparse coverage in your area, maybe you want to look at a different one, or maybe you might want to be better off going with a PPO, even if it's a little more expensive, right? Another important bit is co-insurance, right? Kind of like a fancy word, but it's basically saying, so first we have the deductible, right? first we have the deductible. Let's say $1,000. So any expenses up to $1,000 in a year will just pay out of your own pocket, right? So of course, the higher you set this deductible, the lower your insurance premium is going to be. So if you have a pretty good source of income, you don't have to worry about occasionally having to spend, $1,000 or $2,000 a year on some random health issues, then you should take a higher deductible. Because on average, this is probably going to be cheaper for you, unless you know that you're going to incur that expense, in which case you probably shouldn't, right? So on top of that, there is a certain limit where the insurance company pays only a fraction of your expenses. So oftentimes what will happen is that maybe up to, right? So maybe up to $5,000 a year, the insurance of various medical equipment, the insurance company is going to cover 80% of that, right? So here, so up to 1,000, 0%. 80% up to 5,000. So that as you incur more expenses starting from over the deductible, you're not going to be covered 100%, you're going to be only 80%. And again, this is another way that you can reduce the health insurance premium, right? Because you're only partially covering the risk. So as a result, you don't pay that extra insurance company profit on covering that risk, which you can absorb. Right? But again, 20% of the 5,000 of the extra 5,000 is what? Only another $1,000. So if you figure, hey, I can swallow another $1,000 worth of expense on my own, it's another way that you can reduce your premium and get some positive expenses out of it, right? And then, over 5,000 maybe they'll cover 100%, up to some ceiling. Again, you have to, if you look at a health insurance plan, there is really like a full page of line items of what it will be covering, what amounts, what limits, right, and under what conditions, etc. So it's not, you really have to compare the details, right? Because sometimes some plans will say, oh, if you die, you can get like for $100 a month, right? Then you look at what they're covering, and they're not really covering very much. Or maybe the coverage limits is like, $20,000 a year. So if you get into a car accident and need some major health taken care of, right? Staying in a hospital for a while can rack up money really fast. And if your limit is $20,000, after that comes out, you're on your own, right? Of course, the whole point of insurance is to cover the losses that you cannot cover, right? It's not to cover this. It's not really to cover this stuff. It's to cover this stuff, right? Because this is the stuff that will really ruin you if you happen to have a really significant health expense, right? Spending, $2,000 or whatever, not a big deal. You figure it out, right? So that's really the important thing. You don't go for a plan with low maximum limits because it has a lower premium. Because you're really giving up the really important part of the coverage, which is what happens if you incur $500,000 worth of medical expense. And that's what you're really worried about, right? Make sense? Okay. Related to this is this idea of pre-existing conditions. So actually, some of these laws are in flux, but really a lot of times, if you have some kind of expensive pre-existing medical conditions, insurance companies used to be able to just refuse health insurance coverage. Right? And some decades ago, there were laws passed that if you switch from one insurance company to another, without any gaps in the coverage, it's considered as if you have continuous health insurance, and the new company cannot change your premiums or refuse coverage because of your pre-existing conditions. Right? Now, if you have no health insurance at all, and you have some pre-existing condition, then they could still jack up your premiums or refuse coverage if you have it. Right? But that is the part that's currently in flux with the new healthcare laws and things like that. So I'm not really sure how things are going to fall out. But as a general rule, given the current, the previous legal environment, it's a good idea to have some kind of a health insurance so that if at some point you develop some kind of a condition, it's not going to count as a pre-existing condition and get your coverage refused, right? If you have insurance and you just continue it, then they cannot throw you out for having a condition, right? So how many of you actually have some form of health insurance? Probably covered, probably under your parents' plan or something like that, right? That's good. It's important to have it because repairing your body can get really expensive. So the important thing is at some point, I think right now you're allowed to have coverage under your parents' plan until you're like 26 or something. Right? Who is doing the project on health insurance? Yeah, who is it? Okay, so 26. So after that runs out, ideally you should get health insurance of your own and not let it lapse, right? Because things can happen, bad things happen all the time, right? You may be crossing the road and some guy isn't looking where he's going, right? Or you may get hit by lightning. Anything can happen. So you really, it's not a risk you want to be exposed to. So another, probably not something we have to worry about for a while, I would hope. But another type of health-related insurance is long-term care insurance. Now, right now, like a lot of really old people, right? They stick around, they're alive for quite a while because our medical technology is improving. But, with certain conditions, they require continuous care for a while, right? So, you get people going to nursing homes or long-term care facilities, right? Because they basically require continuous supervision, like people who develop Alzheimer's disease and things like that, right? And that stuff is not covered under regular health insurance, right? So, and a year's stay at a continuous care facility can cost $50,000, right? So, as a result, there we have developed this new type of insurance called long-term care insurance, which specifically covers the expenses of incurring some kind of continuous long-term care, right? So now, of course, ideally, you would buy that type of insurance before you actually require long-term care. Because, once you develop a disease that will require long-term care, you're uninsurable, right? Because the insurance company knows that there is 100% chance that you will incur this expense, right? So there is no premium they can set unless it's more than the actual expense that will let them make money. Right? So ideally, in general, a lot of people take out that insurance, when they're maybe 60 years old or whatever, right? So eventually it might happen that they might require it, and at that time, you can fix a relatively low premium, and then if anything happens, you don't have to worry about where I'm going to come up with the money. I mean, of course, if you happen to have plenty of resources, it doesn't really matter. Or if you're really, really poor, it doesn't matter either because, for people over 65, the government insurance like Medicare and Medicaid will take care of long-term care. But you have to be really poor, right? Because Medicare covers regular health problems, right? So, if you go to the doctor, you need some medicine, Medicare will cover that. But it doesn't cover long-term care. Only Medicaid does. And Medicaid only applies to people who are really poor, right? So it actually brings up a host of kind of interesting issues. A lot of people, once they realize they didn't have long-term care insurance, and once they realize, OMG, I'm going to need no long-term care, right? They try to transfer some assets so they to some other people so they can qualify for Medicaid. So there's a lot of interesting issues involved with that. Hopefully it's not something we have to worry about, and by the time we all grow old enough to worry about it, a lot of things can change, but just so you're aware, it's a separate issue, right? Long-term care not covered under regular health insurance. Okay, so we'll continue from here next week. Hope you have a good weekend.
Going, did you ever send out like a detailed thing, like the form or one form that you did?
No, I didn't because I haven't started my the violent analysis that I wanted to use. I realized
Right? Our alternatives are don't do it. And that's what we decided, so we didn't.